Hey everybody, this is Chuck Marone with Strong Towns. It occurred to me that there's a feature about mortgages that is not widely understood, particularly outside of investment circles, that might be helpful for people to recognize and understand. Mortgages, in a financial sense, are an investment product, right? When you buy a home, you feel like you're buying a home and there's a supply and demand and all that, and you and the seller come to a price agreement. You move in, everything's great. In 2023 America, in modern America, that's really not what's going on. What's going on is that you are a mechanism, you are a vehicle to create the thing of value, which is called a mortgage. And the mortgage is sold onto a secondary market. It is bundled with other mortgages. It is chopped up into pieces along with other mortgages and sold off as securities. You can think of this as a stock in your future payments on that home. This is securitization. It has been around for decades. It is really at the foundation of our financial system. Every local bank owns bundles of mortgages. They are, in a sense, guaranteed either directly or indirectly by the federal government. They're rated AA, AAA generally. And, we have placed this at like the core of our financial system. I want to point out how bad of an investment mortgages are for investors. And this actually creates this like dichotomy in the broader system. But let me explain this to you. If you are an investor and you are going to make an investment in some security that's going to create payments for you. So I am going to, in a sense, loan someone money, and I'm going to do that at an interest rate with that individual, that entity paying money back to me. I'm looking at things like interest rates, right? Like, what is the rate of return on this? How much is this guaranteed over what time period? When we look at mortgages, mortgages are often kind of related to the federal funds rate, to the general going rate of interest. You might get a little bit more off a mortgage than you would off a treasury bill, but it's going to be somewhat similar, somewhat comparable, right? The thing is, when you go in and get a mortgage, let's say at 6%, when you make that investment, I'm going to buy mortgage-backed securities that are paying 6%. I want that 6% return. That's why I'm buying it. And I'm willing to take the risk, in a sense, that interest rates go up and my investment becomes less valuable in comparison. I'm willing to take that risk because I want to lock in that 6% return, right? If interest rates go to 9%, boy, it would be a much better to be a 9% than 6%, but I'm happy because I'm still locked in at 6%, right? I'm going to accept that. And that's a trade-off you make when you buy this long-term product. Only the problem with mortgages is what? If interest rates go from 6% to 3%, that is a case where I, as the holder, as the person who lent the money, am winning, right? Like I'm doing really well. The rest of the market's making 3%, but look, I bought this long-term product at 6%. Isn't this great? Okay, if that were a treasury bill, if that were some other kind of note, that might make sense. But for mortgages, what happens when interest rates go from 6% to 3%? People refinance. People go to the bank and say, I've got a 6% mortgage. I want to close this one. I want to open a 3% mortgage. The government facilitates that. We help pay for that. We help make that kind of thing happen. We almost depend on it in our economic system to keep things going. So I'm the holder of a 6% mortgage. I'm expecting 6% payments for decades. This is going really well. And all of a sudden you pull the rug out from underneath me. I have to surrender that asset. You pay it off in full. I have no say whatsoever on whether you do that. And now if I want to re-enter this market, I have to re-enter at 3%. That as an investment really stinks. The opposite happens then too. If I buy in at 6% and I'm holding the 6% note and interest rates go to 9%, I'm rather crabby about that. You know what? I'd really like to sell that mortgage and get in at 9%. I'd really like it if the person who had that home went and refinanced and redid things and bought out my loan, and then I could, buy a new one. I could enter the market again at 9%. That doesn't happen, right? There's nobody who is sane sitting on a 6% loan saying, I'm going to go to the bank and refinance this to get a 9%, right? I mean, only people in dire economic circumstances are looking to refinance their home when interest rates go up by that much. And so as the investor, you're stuck with this kind of bad paper, right? You're stuck with a loan that isn't moving, that isn't turning over, and maybe it's making its payments, but it's making payments at below market rates. This fundamental paradox of mortgages make it like the most fickle of financial instruments. And to have them placed kind of at the heart of our financial system, like we're going to build a financial system on treasury bills and the American home, makes it so that there's a certain amount of built-in volatility in our system where every time things start to go bad, they're going to go worse. Every time things start to go bad, we're going to lock in that kind of bad and make sure that we accelerate it. We shaft the investor in mortgages every time we can. And the thing is, we can say, well, good. We don't like those big investors. All right, I get it. But so much of our liquidity in our housing market, so much of the reason why you and I can go and get mortgages is because this market exists. One last little note. Why do people invest in these mortgages if there's such a bad deal, if they have this kind of negative impact for the person that's holding them? And the answer is really, really simple, because they're safe. They yield higher than a safe treasury bill, right? Treasury bills are kind of the safest of all investments. A mortgage-backed security is going to yield higher than a treasury note, but it has an implied, and I want to say implied plus, like a little bit more than implied guarantee by the federal government, right? Housing can't go down. And because housing can't go down, I can freely invest in it and maybe even take a little bit of this kind of negative interest rate asymmetry in order to have an investment that I'm guaranteed of not losing money. If you think about that, that has some really weird ramifications for affordability. That's the basis of our housing system.